On this edition of Wealth Nation, types of debt. Different types of debt include credit cards and loans, such as personal loans, mortgages, auto loans, and student loans. Debts can be categorized more broadly as being either secured or unsecured, and either revolving or an installment debt. For better or worse, debt is a common part of life. Borrowing can make it possible to buy a home or a car, school, and finance other large purchases. And while debt can be useful for achieving all types of financial goals, it can also become a large burden if you take on debt for the wrong reasons or without fully understanding what you're agreeing to. Not all types of debt are created equal, however, and different types of debt are useful for different ends. To ensure what you borrow works for you and not against you, here's a breakdown of the main types of debt and what you need to know about each one. What is debt? Debt is money you borrow and then repay to another party, often called the lender or creditor. And when you take on debt, you usually agree to a contract specifying when you'll repay the debt, plus how much interest and other fees you'll be charged in exchange for borrowing. Debt can be a very useful way to achieve goals, such as buying a home, going to college, or financing a car, and different types of debt are best suited towards specific purposes and goals. Sometimes this distinction is obvious. While you can use a credit card to buy groceries or shop for clothes, you can't use one to buy a house. And in the same vein, you can't generally use a car loan to pay for goods and services. But sometimes the different types of debt and their best uses are a bit less obvious. Understanding the various categories of debt is important for being an informed borrower. Let's consider secured debt versus unsecured debt. All debt is one or the other. These two types of debt work differently and have very different consequences in the event of a loan default. Well, what is secured debt? A secured debt is a loan that's backed by some form of valuable property. It's known as collateral. In other words, taking on a secured debt requires you to put a piece of property on the line, typically a house or a car. If you stop making payments, the lender can seize the property that you've offered as collateral. Examples of secured debt are home mortgages and auto loans. These debts are tied to the value of the car or home that you purchase with the loan. If you stop making payments, the lender can repossess the property tied to the loan. In the case of a mortgage, this is called foreclosure. What is unsecured debt? An unsecured debt is a loan that isn't tied to any collateral. Credit cards and medical bills are common examples of unsecured debt. Oftentimes, personal loans are also unsecured debts. Some personal loans do require collateral. Let's talk about secured versus unsecured debt. Take out a secured or unsecured loan isn't always a matter of choice. In the case of auto loans and mortgages, the property you're financing with the loan in itself is called the collateral. So mortgages and auto loans are always secured. In other cases, whether to get a secured or unsecured loan comes down to what you can qualify for based on your credit worthiness, your income, and other factors. Unsecured debts are riskier for lenders because they have less ability to recoup their investments should you stop paying. For that reason, unsecured debts often have stricter credit and income requirements. If your credit is low, you may have the only option, which is to get a secured loan. Making on time payments can help you broaden your future borrowing options. When you have that option, you might choose to take out an unsecured loan so that you don't have to put your home or car on the line. On the other hand, secured debts offer lower interest rates than unsecured debts. So if you're confident that you'll be able to afford payments, you might find this to be the more attractive option. Let's consider revolving debt versus installment debt. When it comes to how you borrow and repay debt, there are two main types of credit and repayment structures: revolving debt and installment debt. What is revolving debt? Revolving debt is a type of debt, such as a credit card or home equity line of credit, called a HELOC, that allows you to repeatedly borrow and repay money that you set up using a credit limit. You can charge purchases up to that limit, then repay your balance, usually with interest, with some flexibility. Typically, revolving debts have set a minimum monthly payment and will accrue interest on only the balance that you carry. Revolving debts typically have variable interest rates. What is installment debt? An installment loan is a loan you receive in a lump sum, and then you repay with set terms, typically in equal installments with a fixed interest rate. Common examples of installment debt are personal loans, student loans, mortgages, and auto loans. Revolving debt versus installment debt. For any type of revolving debt, the major benefit is that you can have access and repay your debt with flexibility, and you'll only pay interest on what you owe. As you repay your balance, you can continue to use the credit that you free up. As long as you pay at least the minimum due each month, you'll be able to keep your debt in good standing and pay it off on your own timeline. For example, you can use your credit card for everyday spending on bills and groceries and pay off your purchases with your next paycheck. It's usually best to pay off revolving debts as soon as possible, though, as interest can accrue quickly. Installment debts can also be an attractive option in some cases because they typically offer fixed interest rates and a predictable monthly payment. They can also offer lower interest rates than some revolving debts. But when you use a debt consolidation loan to pay off a credit card debt, you're converting a revolving debt into an installment debt, ideally with lower interest rates. An informed borrower always makes the better choice.